half odd percent. And there is Dixon, which starts about 1.25% lower. These are well-traded, large, liquid names which are coming up with some cuts. Market breadth has now decisively moved into the negative, 2:1 in favor of declines as we begin the day. I think we highlighted Nazara, which has got 4% gains. Sharda Cropchem is another one, which is coming up with a 6% gain. So some gainers as well, 518 on Sharda Cropchem. CG Power is up 2.5%, of course, reacting to results. And there is Car Trade, long forgotten, down and out, but the stock's up about 5%, back at almost the 500 rupee levels at this point in time. So that's basically a little bit from the broader market. We're down 60 now, 18,058 is where we find ourselves at. More in terms of stock reactions in a bit. Mihir Vora is our market master of the day, Director and Chief Investment Officer at Max Life Insurance. Mihir, good to have you with us here. Thank you very much. The last year we stood out in a good way. This year we're standing out, not so good way. But it's not very much, right? I mean, global markets are up or flat. We are down a little bit. Do you think this phase has got more to run? And what are the big factors which will influence it? I mean, the budget, for example, is just a few days away. I don't know if you have any specific thoughts on that and what the market may do in reaction to that. But to your mind, what will be the dominating drivers?
Good morning, Prashant. Always a pleasure. So, if I were to just summarize in a few lines the current market and global situation, it's compared to, say, 3 or 4 months ago. Now the concerns about inflation, peak inflation, are past us. The concerns of very bad recession are also probably past us. So the peak fears of inflation and growth are probably past us. And that's because of the incremental data that we are seeing over the last few months. It's that the Europe slowdown is not as bad as feared. People are really expecting Europe to collapse because of the energy crisis and gas prices, but it's held up quite well. And in fact, they've adjusted the energy mix quite well. And the mild winter also helped. The US slowdown is probably a bit worse than expected, but again, people are now talking about a mild recession rather than a very sharp recession. And the third thing is that the China opening up has been much faster than expected. So the worst of the growth fears are also probably past us as far as the global economy is concerned. So to that extent, the peak hawkishness of central bankers is also probably past us. Mostly we are talking about 1 or 2 more rate hikes and then done as far as the global central banks are concerned. So I think the worst of the fears on interest rates, inflation and slowdown are gradually petering away. And to that extent, when we were taking the call last year, is that India will do much better than the global economy because of the global concerns. That argument is a bit more diluted, and that's reflecting in the market performance. So while India may continue to do well in absolute terms, we are seeing catch up by the rest of the world, especially the US tech space, Chinese market, etc., because they were really beaten up last year.
Well, by the way, I just want to mention that the market cuts are deepening. So the Nifty is now down almost 75 points. It's interesting to see the list of losers because banks are now seeing some serious underperformance. The bank Nifty itself is down 200 points. And you have all the top losers are banks, Axis, SBI, HDFC Bank, a couple of others in the smaller names as well. Amir, I wanted your thoughts because, are we seeing a churn now out of banks and into IT? Just purely to catch the valuation upside?
Absolutely. So as I said, the US tech space has really done very well in the last couple of months, of course, from very sharp bottoms that we saw last year. And Indian IT is kind of mirroring that expectation or that movement because we've not seen really bad earning cuts as feared. Though my expectation is that if the domestic economy continues to do well, IT is still overvalued relative to, say, 2019-20. It's been one of the most re-rated sectors, so to say. But if the domestic economy doesn't do as well, then IT can outperform. That's the call that we have.
Hi, Mihir. Talking about the domestic economy, the sector that's come in for a hard knock has been cement, in the last few days particularly. That was, a favorite. I mean, people were counting on 2023-24 to be a good year, given that we have elections that are coming up, construction work, housing sector demand as well. As a house, what's your view on the space?
So cement, we are neutral on the sector. The sector had done well because there was expectations that with a new player coming in, there'll be massive improvements in cost, and we did see some announcement to the extent of curtailing cost of transportation, etc. I think that theme will continue. The reason why the cement sector underperformed last year was basically because of high energy costs, and those energy costs are coming down. So even if the transportation, etc., efficiencies by the new player take time to come up, there will be improvement in the other costs because of the energy, energy prices going down. So to that extent, if there is pricing discipline, which I think it is, the cement sector may actually see earnings upgrades even without much action on the other side. So to that extent, we are not as negative on cement as we were last year.
Okay, that's interesting. So just to follow up there, you're saying cement sector may see an upside. What about the ancillary spaces? So there's real estate, there's infrastructure, there's home improvement. This entire theme picks up together generally. Do you like this space?
No, because I think in all those segments, while they are good growth segments, valuations are not very comfortable, and most of them are mid and small cap stocks. So anyway, we don't have too much exposure in our large cap fund, which are typically our flagship funds. But even now, I'm not really comfortable in the building materials valuations, as I said. So to the extent we have very minuscule exposure there.
Mihir, the entire consumer space, right, consumption basket, is this, you think, just like a bit of a valuation reset which is happening, or you think, looking at results, and now we have numbers from Pidilite, last week we had so many numbers, right, from a wide array of sectors within the consumer space, is there a worry that maybe there is a bit of an underlying slowdown which will continue to fester for the bulk of this year? What's your sense?
Sure. So the consumption has been a mixed bag. In the first half, we saw rural doing okay, and the second half, the rural slowdown was really apparent. And urban was relatively picking up, especially the discretionary space, maybe partly because of pent up, the busy season, and revenge travel, revenge spending, etc. But in the last few weeks, again, we are getting signals that urban consumption probably might be faltering a little bit. But on the other hand, there are some incipient signals that the rural space might be picking up a little bit. So I think rural inflation, which was one of the big causes of rural slowdown last year, is hopefully past us. The peak rural inflation is past us, and we should see rural recovery slow but steady in the in the next few months. My guess is that the government focus on the budget will also be more on the rural side, so rural capex spending, etc., may still continue. And because of the little bit of loss of traction on the urban side, you may see some initiatives in the budget, something like urban Manrega, maybe increasing the income tax slab rates for the salaried urban class. So to that extent, maybe some focus to help the lower end consumption, which is not seeing that much of a traction even last year and even as we speak. So I think high ticket consumption was doing better. Low ticket consumption, both on the rural and urban side, seems to be picking up a bit slowly. So you might see some initiatives towards that.
Okay, all right. Well, we'll leave it at that. Mihir, thanks a lot for joining in and giving us your view. The market is under a bit of pressure now, so 78 points lower. Thanks for that. But a couple of stocks deserve mention. TVS Motor is up 2.5% right now. So that stock is doing quite well, actually, post its numbers, as well as the commentary that came in from the management, where they have raised their guidance. So 2.5% higher on TVS Motor. Sona BLW, and we'll talk about that in greater detail as well. Good numbers there too, up almost about 2% Route Mobile had a strong showing yesterday, and that's adding on some more weight. So 4% higher on Route Mobile. And UCO Bank, after the management commentary, UCO Bank is up almost about 3%. So there are stocks which are sort of seeing outsized gains despite the market being very, very quiet. So names like Shoppers Stop, Relaxo Footwear, Chalet Hotels, a couple of other names which are outperforming. We'll also talk a little more in detail about SBI Card in a bit. So let's just get SBI Card, the stock, up for you on your screen. This time, the net interest margins were at an all-time low. So I think that is something that's really dragging the stock this morning. So we're going to talk in greater detail about that. By the way, a couple of other result reactions include the likes of United Spirits, so that one as well is down almost about 4.5%. So there are, result reactions in the market, but overall, you'd have to say it is a quiet start.
It's a quiet start, absolutely. Maybe just a few more names before we bring in our next management. Nykaa is a name which you may want to look at. It's down 1.5%. Stock was up 7% yesterday on very strong it was up 7%. Has underperformed, lost about 70% from the highs. Yes Bank is down about 1.25%. I pointed out Ambuja Cements. ACC is another one which is down a little bit. And you've got a bunch of these other names which are, there is more down than up at this point in time if you look at the broader screen. Sonia.
Okay, we were just mentioning how SBI card is under pressure post the disappointing set of numbers. The net interest margins came in at an all-time low for the bank. And over the last few quarters, the revolver rate for SBI card has also come down to around 24% from the earlier 45%. Ram Mohan Rao Amara, who's the MD and CEO of SBI card, joins us now.